Good evening, all. So, I suppose most of you have come across straddles, triangles, etc. etc. And right now, considering the fact that the markets has been a lot volatile, so if you are someone who is just doing naked straddles with fixed stop loss, there's a very high probability that you have your stop losses being taken out. So we see a large number of people actually searching out for systems where they are either using an iron fly or maybe an iron condor. But howsoever, today to my surprise, I came across like one of my teammates itself, who was actually started off having a position as an iron fly. But then later, when the markets went directional, he was actually sitting idle. So when I asked him, okay, why are you sitting idle? The answer he gave me was that, okay, my maximum loss is going to be realized. And that's fine because he knows, okay, iron fly, when you're doing, you get something like a 1 is to 2.5 risk reward ratio. And he's like, okay, it is fine. But many times people completely keep aside the opportunity where you could convert a losing trade into a winning trade by making some sort of an adjustment or kind of collecting some extra credit or doing a fresh debit spread according to your directional view. So I thought, okay, fine, let's kind of actually do a video where we are quickly talking about how you could manage an iron butterfly. This particular person has done the position in Nifty. So let's go ahead and have a look how an iron butterfly that went wrong can be converted into a winning position or at least a break-even position. So in this particular person's case, he started off by having a loss, but then he was able to convert it into a winning position that generated him like 1.5 percentage returns, which is amazing. So simple things were done over here. He collected more credit and he extended the range to break even. So let's have a look at the same. So this position also basically started as a normal iron butterfly. To simply mention the strikes, so he started by creating a short straddle at the 17600 call and put, expecting markets to stay confined within the range of like plus or minus 200 from 17600 on last Thursday. Now, he bought the 17800 call option and the 17400 put option as the hedge for the strikes that he has sold. So now let's have a look at the payoff diagram first. So as you see in the payoff diagram over here, for this particular spread, where 17600 has been solved for like 144.3 and 17600 call has been solved for around 192.35, we see that the net credit that we are receiving out here is 192.35 plus 144.3 minus 100 plus 75 plus 70 cent, that is the amount that we are paying up for the hedges. So in simple words, the range that you're going to get is going to be nothing else but 17600 plus 144.3 plus 192.35 minus the debit that you pay minus 100 minus 77. So which accounts to, as you witness out over here, the range that you're going to get on the upside is like a plus 160 points and the same thing on the downside. Howsoever, this particular Monday, okay, so this particular Monday, you must have actually seen that as per this particular charts, the break even is at 17,760. That is 160 points above the 17,600 strike. Markets were kind of pretty much bullish that the price managed to breach the 17,760 marks. And this particular person, what he felt is, okay, my upper break even has been breached. That means, okay, fine, the price has actually kind of went to the loss making territory. Okay, so for this particular setup that he was doing, per set value, it is like your maximum profit is going to be like a 7.9k, whereas your maximum loss is going to be a 2k. Okay, so your risk reward, yeah, I totally agree, your risk reward is pretty much satisfied. Howsoever, like this person, like he felt, okay, I need not do anything. Why? Because it has went into the loss making territory. If the market falls down, fine, let it become profitable. Else, let me just take a loss. So then, like we were just kind of discussing, and we were kind of discussing the concept of how more credit could be received, and you could actually convert this position into a winning trade, even though the price has actually moved from your break-even point. So this was that particular point in time and market actually moved extremely bullish and it picked up beyond our break even. Okay. So I'll just tell you the thing that we did in order to collect extra credit and to extend our range further. So first and foremost, just have a look over here. Two additional sells were initiated. So one was like selling the 17850 put option, and this is crystal clear. Why do you sell a put option? Because you expect the markets to go bullish. So the 17850 put option was sold for a premium of 78 rupee, expecting the market to go on the bullish side. Okay. Now the 17950 call option was sold for a premium of 27. So if you ask me the reason why 17950 is because of the fact 7900 was saying good rate writing. So yeah, so we sold like just 50 points away. Now talking about why 17850 put option. Okay, so first and foremost, let me tell you the reason we are selling put option is because we have a bullish view. Okay, so our spread kind of actually started becoming red because of the fact the market picked up beyond the upside break even, as I mentioned, from 760 to 7 sorry, from 17,600 to 17,760 plus. Okay, so we sold an extra 17,850 put to collect an extra 78 points premium. So here, if you have a look at the payoff chart, you realize that okay, the market is to go bearish, or the markets are actually to stay sideways. There is really not much of a change that is going to happen. You and if the market settles exactly at the same point, you would have got something like an 800 900 rupees profit. And definitely, as far as the spread, that is going to be in a loss if you are gaining even an 800 rupees. It is like a 0.4 0.3 percentage on your capital deployed. Okay, so for selling this additional call option and put option, obviously we need to bring in more margin or we need more funds. That is more or less like double whatever you had deployed earlier. However, as far as someone who wants to convert a spread that is trading into in a loss into a winning position is concerned, it is definitely needed. So one disadvantage, if you ask me, in this particular case, obviously the loss is going to be unlimited if the market slides unlimited on the upside or on the downside. But it's kind of actually extraordinary that these kind of situations happen. So in fact, we had a range of like 200 250 points on the downside, and we also had a range of like around another 200 points on the upside. Okay, however, I just wanted to mention this particular day, that is like yesterday, Wednesday, the markets actually had a great drop. Okay, so which kind of put us in a bit of a panic. So why? Because okay, market is kind of sliding down a lot, and it could now break your lower break even, and if it falls further, that means you're going to take a huge loss. So under such situation, like you should be prepared to fight your positions by taking some directional trades with a better delta as compared to your present position. That particular day, that is Wednesday, yesterday, when the market slid down a lot, there was kind of not much of a use going to be to hold on to the 17 and 50 call option. Why? Because yesterday itself, like the premiums had dipped a lot, it had come to around 4 5 rupees. And we exited this particular strike that is sold for 17 and 50 at a value of 4 rupee. Okay, so then later on, what was done is we sold a fresh uh, like to replace the 17 and 50 call, we sold a fresh 17 850 call for like around 8 rupee. Now, if you ask me, like, is it totally worth it? The answer is no. Why? Because you'll still pay like around 2 rupee charges, and just for like 2 points that you're paying uh, an extra 2 rupees charges. Okay, so yeah, so we saw like a fresh 17 850 call and collected an 8 rupee premium. Or we exited the 4 rupee one. If you ask me why, okay, that point of time we just did that. Okay, so now what happens is when these two positions come in, okay, the downside, yes, you can gain a bit more of a profit. However, not much of a changes are going to be there. I'll show you the new payoff diagram now. As you can see over here, so this is the charting platform of Obstra. Okay, so over here we can see that okay, initially the 17,850 put was sold for 82 rupee, and that was actually made to expire worthless today. And the 17950 call option had been sold for 26.6, and towards the end of the day, that is on Wednesday afternoon itself, the strike was actually exited at a premium of around 4 rupee because the markets went bearish, and there was even further possibility of collecting more premium, and that was done. Okay, so after exiting the 17950 call, that was when the 17850 call option was sold for around a premium of some 8 point something. So it's returned 7.95. Maybe the value extracted at that point of time was 7.95. Okay, so by doing this, the spread actually got a bit more of a profit on the downside. Earlier, when it was like around 800 rupees for the set, it ended up becoming like a 1000 rupees for the set. Okay, so now what happens out over here is then the next day, that is today on Thursday, our markets ends up having a good gap up opening. Okay, so if you have a look at Nifty 50 for the day, so Nifty 50 in fact had a gap up like after from the last traded price at 17,626 yesterday. Today the market opens at around 17,800. That is like a pretty good gap up. Okay, so because of this single gap up itself, the spread that was actually trading at a loss the previous day once again comes back within our range where the maximum profit can be realized. And the MTM from around like a minus 5k per lot per set. Okay, per set means one set over here is like every strike is solved with 50 units. So at around like a 5k loss per set, the spread once again comes back to a loss of around just like 400, 500 rupees per set, which is very less. Okay, so now what happens is when that particular gap up happens, so initially you remember the 17600 call or 17600 put option that you had sold for 144.3. Okay, so today after that particular gap up, this 144.3 by the middle of the day, this premium ends up becoming like just a 4.35. And at some point of time, our markets were kind of actually looking kind of more or less pretty much bullish. And that particular point, the 17750 put option had been sold with this perspective of collecting more premium. That is, this was trading at around 5 rupee when the 17600 put was actually trading at around 4 rupee. Now, I'll just quickly show you how the payoff diagram changes because over here the payoff doesn't look really good. I'll quickly show you how the payoff diagram basically changes with the change in selling an extra 17750 put and removing the old 17600 put option. Now you can actually witness over here that the 17750 put option has been sold in order to add an extra credit of just 15 points. Okay. Now, if some of you are kind of wondering, okay, how does this become 155.8? I just wanted to tell you. So I mentioned to you that I had exited the 17600 put that we had sold, where we had actually collected like a 140 points premium. So on top of that 140, I collected the extra 15 points premium that we are going to collect and mention the combined premium to be 155.8. So that is what is written over here. So once again, if you have to get a good picture, you have to look into the Obstra chart. But then this thing, I really don't know how to zoom it further. That is why I'm showing it you on Sensible, because I can mention the premiums. Okay. So once again, like this 17600 put that we sold, I had deleted over here. Okay, from this particular list, I have deleted it, and I had actually brought in the 17750 put option, where whatever premium I collected earlier, that also gets added up over here. That makes it 155.8. So then the payoff chart kind of completely changes to something like this. Okay. So what happens is if the market turns bullish, you realize your maximum profit of like around a 4 percentage, and if the market settles somewhere over here, you kind of gain something like a 1.5k. Okay, so that is how this particular spread goes, and ultimately this was what we were actually holding on to. So at some point of time, we became really happy. Why? Because the markets went bullish, and even it was kind of halting somewhere at the 17850 marks for a while. Okay, so when the markets were kind of actually halting somewhere at 17850, we were actually kind of having an MTM of around 2k, 2.3k something per set, and in fact, that is more or less just a bit away from the maximum profit, right? So as far as the spread that you started off with the wrong view is concerned, you converted it from a losing trade to a trade that is making you some decent profits. So that is the beauty of doing spreads, and that is why I personally like doing spreads too. So at the end of the day, this spread is kind of actually being closed with a profit of around like 1%. No extra 1% because in fact like there has been like more call options that has been sold. Okay, which I'm not mentioning over here. So why? Because that'll just create confusion. So extra call options were kind of actually sold with directional views when the market actually took some sort of a dip in between. Okay, so more or less I could say. So even if you start with something like an iron butterfly, even if one of your break-even points are getting reached, so don't give up. So don't. So I'm not saying you to keep on fighting the markets. So what I'm trying to say is, if possible, if you're getting some sort of a directional view, convert this non-directional spread that you started off into a directional spread. So that is the beauty of it. So that is the beauty of doing spreads itself. Okay. So if you know how to collect credit at the desired locations, you could definitely do that. So this is like just like playing chess. So I just wanted to mention those. So there are kind of actually no hard and fast rules. However, like we personally, what methodology we follow is at any particular point of time, our break even is getting reached. That is when we think about collecting more credit. So until and unless that is happening, we really don't do anything. So I hope you get some value from this video. And alongside with this video, I'm just kind of actually just quickly sharing the trade logs. And this particular friend of ours has taken the trade from Zerodha. So since most of you use Zerodha out here, it could be really useful to you as well. So I hope you find some value in this video. Thank you all.